So welcome to 1031 Exchange FAQs. My name is Brendan Lewis and I'm with Accruit. I have on today a guest, Martin Edwards, who is also with Accruit. Marty has been facilitating exchanges and involved in exchanges for 33 years and has extensive experience in tax deferred exchange and about 20,000 some odd exchanges he's been involved with, which is pretty impressive. Marty has written and spoken extensively on the subject of tax deferred exchanges. He's a certified exchange specialist through the Federation of Exchange Accommodators and is a current member and past board member of the Federation of Exchange Accommodators. He's a member of the Chicago Bar Real Property Committee and serves on the board of directors for the Land Trust Council of Illinois. It's been a great resource to me. And the purpose of this webinar really is to just, ideally, we've got some good understanding of 1031 exchange, and these are really just a lot of the questions that come up for both myself and Marty as well. So we'll get started here. First off, Accruit, a little bit about us. Accruit is a leading independent trusted provider of 1031 exchanges and the only company that leverages technology in this space. We specialize in complex financial instruments, so you don't have to, allowing me to focus on your business. And we are a trusted and we are an independent and non-competitive, freeing you to focus on driving value. Started a little bit over 20 years ago. Our teams are highly credentialed, and as you'll see, we start getting into some of these topics. Move on here. So first up, what is the 1031 exchange? So we'll do a real quick kind of overview, and then we'll get into some of these frequently asked questions. The Internal Revenue Code allows owners of investment real estate to defer capital gains that would be due upon the sale of investment real estate if those proceeds are reinvested within 180 days. And Section 1031 of the tax code states, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. There's a couple of general requirements to complete a 1031 exchange. Both the property surrendered and the property received must be held either for productive use in a trade or business or for investment. Both the property surrendered and the property received must be held either for productive use in a trade or, oh, we've got a duplicate there, something happened. Third one is there must be an exchange as distinguished from a sale and a purchase. Not sure what happened with that second one there, but so we'll get into this. Marty, are you on the line?
I am.
Great. All right, so Marty has been a great resource to me and clients for years. I probably talk to him at least almost probably every day. There's questions that come up, and he's a great sounding board for me and for our clients as well. So we'll start off basic and we'll get a little bit more complicated. You'll notice that most of these slides will have sort of an extensive amount of text toward the bottom, not necessarily something you need to read as a viewer, but more so for replay purposes. Later on, we'll send out the webinar and we'll make it, we'll publish it as well. So Marty, let's start up. What is a 1031 exchange?
Well, basically, I would describe it as a way to basically link what's really an unrelated sale to a buyer to a purchase that might happen up to 180 days later. And so without a 1031 exchange, it's just a sale followed by a purchase. So it wouldn't qualify. But that's the intent, that if you link the two transactions together, they're actually deemed an exchange of the one for the other. And as such, under Code Section 1031, the client would receive tax deferral on a federal level and in almost all states. And there's other taxes too, but those can all be deferred with an exchange.
And real quick, any kind of a little background on it in terms of how it got started or origin?
Yeah, people would be surprised to know that it first came in the code in the year 1921. And basically the premise was that people are having a continuity of the investment. They're not putting cash in their pocket when they sell an asset. Rather, they're just moving over the value into a new property that's like kind in this case. So that was the original idea, and it's been largely unchanged since 1921. We're almost at 100 years of having this in the code for good reasons, and there's currently some challenges now with potential change in administration that might change it, but there's a good reason why it's lasted all these years.
And with 1031 exchange, a lot of people hear the term qualified intermediary interchangeable with exchange company, but what tell us about what a qualified intermediary is and what do they do?
Well, it's consistent with what I said before, that there's a way you have to link the sale of the old property to the purchase of the new property. And simply by selling on one day and then buying with 180 days doesn't link those things together. So although it's a bit complicated, the IRS came out in some regulations in the year 1991 with the term qualified intermediary as the middleman in this transaction between the taxpayer and his or her buyer, and the taxpayer and his and her seller. It kind of links the transactions together in a way that's a little bit more complicated to describe than for purposes of this webinar, but that's the role of the intermediary, to basically change the thing from a sale and a purchase to an exchange of the one for the other.
And another question that I get, and it's not so much probably as common as now as it maybe was before, but talking about types of assets that are able to be exchanged. Do you want to go over a little bit about that?
Well, it used to be more complicated when personal property was also part of the ability to do exchanges. That changed with the changes in the Tax Act and that came out effective January of 2018. So really now the only assets that are capable of being transferred consist of real estate. And in terms of, we get this question a lot, does the real estate have to be the same kind as that I purchased based on what I sold? And the answer is no. The nature and character of the property don't matter. Really, all real estate is considered like kind to all other real estate. As a matter of fact, there are some types of real estate that people wouldn't normally think of, such as air rights, water rights, interest in a co-op that might be held for rental, and a lot of other things, easements that are like kind to conventional types of real estate.
And I think that that's really interesting too, what you just touched on, because a lot of, some people in the real estate space might have an understanding that part of the code changed in 2018, but they don't know to the extent of the other types of things that can be exchanged. It isn't just investment real estate. So you've got the owner user aspects when it comes to use in a business or trade, and then the other ones that you mentioned, easements and things like that. So I think that's interesting to touch on. So tell us a little bit about, this is something that while it might not be, an exchanger might not know the term, but tell us about same taxpayer requirement and kind of what kind of questions you get about that.
Yeah, this does come up often too, because I don't think the code actually uses the word or the regulations, the same taxpayer, but basically the tax entity that's selling has to be the same tax entity that's buying. And so, for instance, if you're selling in let's say in a sub-S corporation, as an example, and you don't want to retain that anymore, you just want to buy in your own name, you can't do that, because even if you're the sole shareholder of the sub-S corporation, that has a separate EIN. It's got its own tax identity, and so you have to acquire in the same fashion. A very typical similar scenario comes up when, let's say, a husband and wife own a property in an LLC because they want to limit their liability. And a two-person LLC, unlike a single-member LLC, is a distinct tax entity. And oftentimes they'll go for getting financing on their replacement property, and the lender will say, "Oh, we can't lend to an LLC. We can only lend to you as husband and wife individually." And technically, the husband and wife individually are not the same as the two of them as the sole members of an LLC. So you don't meet the same taxpayer requirement. There's ways to get around it, but it's problematical. That's what the requirement means.
And this is something that you and I have seen a lot recently when it comes to financing as well. Do we want to touch on that a little bit?
Well, that's really what I was saying, when they go for financing on their replacement property, and the lender will say, "Oh no, our loan programs will only allow to loan to you individually, not to your two-member LLC. That causes a problem.
Okay. This is a question that I get quite often, and in terms of, it's not necessarily addressed as a question, but more so people have a little bit of a misconception about this. But does an exchanger have to reinvest all proceeds for it to be considered a valid exchange?
Yeah, that's a common question that I receive as well. And the answer is no, you don't have to reinvest all of your proceeds. But there's a term that we use in the industry saying that you have to trade up or even in value. So to the extent that what you buy something for at least as the value of what you sold, you should be okay and have full deferral. But there are times when people say, well, I want to take $50,000 or $10,000 out from the time of the sale for other personal needs. That's perfectly fine. And you can do that when you're closing with the title company. But the amount taken out would be boot, as it says on the bottom of the slide. It's called boot, and that portion would be taxable.
And along the same lines as this is really where I think there's a misconception with this next one. When doing an exchange, is an exchanger only required to roll over the gain? That's kind of a common misconception with folks that I talk to.
Yeah, that's true as well. And people tend to think, or hopefully think, that when they do an exchange, they can pull out the value or the amount of their original investment and just roll over the gain in order to shelter it. But unfortunately, that's not the way it works. The first monies out are going to be attributable to the gain. And so in order to protect the gain from taxation, essentially you have to roll over the full value, except for closing costs and things like that. So basically the net amount that goes into the exchange account is what has to be rolled over. And you also need to get equal or greater debt on your new property compared to what might have been paid off in the sale of your old property.
And something that this is, like I said, something that comes quite a bit. There's also the next question that I get asked pretty frequently, and it's interesting because we can relate it to something that's happened recently. But are there any extensions regarding the 45-day identification period or 180-day exchange period?
There's no extensions for good faith issues. Maybe, the exchanger got COVID, or the exchanger got hit by a car, and they can kind of write into the IRS asking for good faith extensions, but there are none. The only type of extensions you can get, and actually one came out today or yesterday, is for what we call a federally declared disaster. And in that case, the 45 days and the 180 days is usually extended by 120 days from what it would have otherwise been. There was a lot of confusion with the COVID situation because the IRS published something called an extension notice to give people some more time, but it wasn't technically couched as a federally declared disaster notice. And so unfortunately, it didn't give as much time as it would have had it been declared a federally declared disaster. It did give some relief, but in some respects, it caused more problems than it was intended to solve.
Yeah, I think that a lot of, especially first-time exchangers, they think that because this is an IRS situation, that just like you can extend your tax returns, that you can extend this. So that's something that, like I said, does come up frequently, and it's a good one. The next question is an interesting one. Can I pay my attorney fees? Can I pay my attorney fees out of the exchange account? And I guess with this question, I also elaborate in what situations would an attorney be required in these closings?
Well, I'd say it's a rule of thumb. It's best just to pay the attorneys out of either personal funds or to, have it paid outside of closing or at the time of the closing, especially on the sales side. So the attorney can be listed on a settlement statement and paid by the title company, but it's not the best idea to pay attorney's fees out of the exchange account. There is a provision in the regulations about what can be paid out and what can't. And something like earnest money for the replacement property is a no-brainer. And of course, so is the payout of the balance of the funds in the account towards the purchase of the replacement property. But other things like loan fees or points and loan application, you definitely cannot pay out of exchange funds. Attorney's fees is maybe in a little bit better category, but the regulations say that there's kind of two requirements for something to be payable that can legally be paid out of the exchange account. And the two-pronged rule is that the fee has to relate strictly to the exchange transaction. So if part of the attorney's fees are for some other legal work the attorney did, and plus the work for the exchange, the portion for the exchanges can only be paid out. The second thing, which is the more difficult one, is that the type of fee in question, in this case attorney's fees, are something that would be typically found on a closing statement in the jurisdiction where the property is located, the transaction took place. And so, for instance, if I'm in Illinois, attorney's fees may not necessarily appear on closing statements in this jurisdiction. Where Brendan is in Texas, maybe it is typical that attorney's fees appear on a settlement statement on the closer side or the buyer's seller's side or the buyer's side as relevant. And so you have to meet these two-pronged tests in order to pay them out. Typically, what I do is I say to the lawyer, send me an email or some information saying that, in your opinion, these two tests are satisfied, so that I'm not forced to make the decision about whether it's appropriate or not.
And in terms of for somebody who's maybe not done an exchange or is kind of newer to this process, what types of services would these attorneys be providing? I mean, what are they doing? Why somebody needed to enlist the help of an attorney in this process?
Again, there's attorney closing states in the United States. Illinois is one of them, but most states, especially west of the Mississippi, are escrow states, and so unless there's a legal problem, they're not really using an attorney. But again, especially where I am, the entire real estate transaction on the buyer side and the seller side, they'd have legal representation, and you can pay $500, $800 or something for a closing.
Right. So the next one, we kind of touched on this earlier, talking about what we refer to as allowable expenses, and it says, can I pay my replacement property loan application and related fees out of my exchange account?
Yeah, I do think we covered that in the prior comments, but no, you can't. Those are not considered the like kind application of the exchange funds towards the like kind purchase of like kind real estate. They're being paid for a loan in connection with it, but not for the real estate acquisition itself.
All right, we touched on that. This is one I don't get this question very often. I think people sort of just kind of take it as a fact that and they don't. I've never had any questions, but you probably have about this. But why is a qualified intermediary a requirement for a valid exchange, and are there situations where one is not required?
Well, it's practically impossible on what we would call a delayed exchange, where the exchange event is not happening simultaneously. So on a simultaneous exchange, maybe Brendan transfers something to me and I transfer something to Brendan. We sit down, we do it at the same day at the same time. And you don't necessarily have to use a QI in that scenario, although there are certain things you need to do to make sure it gets exchange treatment. But most transactions don't take place on a simultaneous basis. So to the extent they're delayed, similar to my opening remarks about a qualified intermediary, the only way you can kind of link the sale that takes place on day one from the purchase that takes place somewhere future in time that's not simultaneous, you have to have a QI to pull the whole thing together.
And in the instance, am I right that sort of exchange originated in as simultaneous exchanges? I mean, that's kind of the origin of it. It was two people that wanted to exchange property.
Essentially, that's right. And then it morphed into three people, but it was still simultaneous. It wasn't until the famous Starker decision where it became allowable on a non-simultaneous basis. And that led to the use of the QI.
So now we're going to start to kind of switch gears a little bit and get a little bit more, it's kind of some more challenging ones. First question in that regard, does it jeopardize my exchange if the other party to the sale or purchase contract chooses not to sign receipt of the notice of assignment? So first, Marty, if you could elaborate on what that means if somebody doesn't know, and then answer that question.
As part of the use of a qualified intermediary in the regulations, it says that certain rights under the sale contract on the first leg and the purchase contract on the second leg have to be assigned to the qualified intermediary. It really doesn't mean much, but it's a requirement for a valid exchange. And so the other thing in the regs indicates that that assignment of rights to the QI has to be given to the other party, the counterparty in the transaction from the taxpayer. And so historically, it's been very, very common to ask the other party to sign a receipt that they got the notice so taxpayer can prove that they abided by it. But sometimes there's bad blood or other issues where the other party doesn't want to sign it, doesn't want to help the taxpayer. That's perfectly fine. The only requirement is that they be given copies of the assignment, and but they don't necessarily have to receipt form as a legal matter.
Okay. This next one, I know that I probably discuss this with people on a weekly basis, and it's regarding can some of so this would be if a property was held, the title holding entity was an LLC with multiple members. Can some of the members of an LLC do their own exchange or cash out at the time of the sale of the property? That's something that, like I said, comes up a lot for me, and I'm sure just for you. Do you want to elaborate on that? And
yes, it actually came up in a question this morning from somebody that I haven't had a chance to get back to them yet. But yeah, it's probably the most frequent question I get sitting at my desk day after day, because so many properties are held in an LLC or a partnership, which for this purpose and a lot of others are really taxed the same way. And so unfortunately, the regulations, not even the regulations, but the code itself has a provision in it that you cannot do exchanges of partnership interests or membership interests, which is what the member or the partner has. So no, on a simple level, the individuals can't do their own thing. The LLC or partnership can do an exchange, but the individual members can't do their own thing. There is a way to get around that with the benefit of enough planning time, where you can drop out either all of the members or those that want to do exchanges from the partnership for a period of time. The longer, the better. And then once they establish an ownership in their own individual capacity, then they might be eligible to do an exchange at that point.
And one of this kind of ties back to that same taxpayer requirement in that, and this one of the ways that I explain it to people, where if you have an LLC and individual members of the LLC want to do an exchange, but and others don't, then that same taxpayer requirement is not fulfilled, because you've got an LLC as a seller, and then you have an individual or another entity as a buyer, and so that plays a part in it as well, right?
That's right.
Yeah.
That's why if they can drop out and establish their own holding for a period of time under their own tax ID and so on, that's why it's possible to do it in that fashion.
And if somebody asked you how long, I always kind of hesitate to answer these questions, but how long should somebody wait between the sale of, or between dropping out of that LLC and a sale?
Yeah, there's nothing anywhere that has an explicit safe harbor for that time period, but most of the experts and the commentators suggest that at a minimum, it has to be before the contract for the sale is signed. And it's helpful then for the sale contract to be signed by the individual, as well as either the partnership or the other people that dropped out. They're still part owner of the property, but they're not in the entity that's selling.
So before the contract is executed, but and I've heard things that you should wait a tax year in between that. I mean, is that?
It's ideal, but it's not realistic, because usually they're interested in selling when you get the call about this. The other thing that does help, though, is if the drop crosses tax years. So let's say you drop out in October and the property's not sold till February, that's helpful too, because it kind of takes it off the tax return for the first year.
Next one, this is something that comes up on occasion. This is in terms of related party type transactions. Can I buy my replacement property from my relative, such as my son-in-law or cousin?
Yeah, that's a trick question, because in general, you can't buy replacement property from what's referred to as a related party, which primarily is a relative. But what that really means is that lineal descendants are really defined as relatives. So you couldn't buy it from your son or your daughter or your own father, but other relatives such as a son-in-law or cousin are kind of not in the lineal tree, and you would be able to buy a replacement property from a relative that's not defined as a related party.
Got it. This is on the same topic. If I'm involved in a related party transaction, is it cured if I hold onto the property for at least 2 years? And explain what we're talking about when we say cured.
Again, a related party transaction means that you're basically buying your replacement property from a related party. So if Brendan and I are brothers, or more likely father and son, but if we were defined as related parties, and I'm doing an exchange and I want to buy my replacement property from Brendan, I couldn't do that because of the related party rules. But if for whatever reason I had some property that Brendan wanted and we were related and he had what I wanted, we could do an exchange with one another, provided that we both held on to the property that we received from the other for 2 years post-exchange transaction.
Good.
There is another exception too, that if I'm doing an exchange and I buy my replacement property from you, but you're not exchanging with me, but you are doing your own exchange with somebody else from the proceeds from the sale that you got by selling to me, that's another exception where the related party rule won't cause a problem.
So going back to qualified intermediaries, this is a question that I get often in terms of talking about identification, the 45-day identification period. So under the safe harbor, is the qualified intermediary the one to whom I have to give the 45-day notice of identification to?
That's by far the most common way, and most people think that that is the only way, but the reality is that the regulations have a kind of a curious provision in them, and it says that the 45-day notice of identification can be validly delivered to any party to the transaction. So for instance, if somebody is negotiating with a seller of a replacement property within the 45-day period, and they make the offer or they sign the contract and there's language in there saying this constitutes or identifies this property as my replacement property for my exchange, that's perfectly valid. It wouldn't necessarily have to go to the QI.
So if somebody had submitted an offer on, let's say, 2 properties and they had included like a cooperation clause in there, and that they intended on purchasing these properties with exchange funds, is that something that would suffice?
You know, that's a good question. It actually came up a couple of times during the course of my career, but I would argue no. The exchange cooperation clause is just a kind of a general clause that says that the other party will cooperate with the client's exchange transaction, but it's not identifying the property in that kind of wording as their replacement property. So I don't think it rises to the level where you could count on that general language as an identification.
Are there any special rules regarding notice of assignment when there are others selling with me or buying with me?
Yes, this is also a common mistake or omission that even some QIs make.
Maybe also give an example of that kind of a scenario.
Did you say I would give an example?
No, I said, yeah, give an example.
Okay,
also.
I'm sorry. I thought you said you were going to give an example.
Yeah,
for instance, on your relinquished property, again, maybe Brendan and I are college roommates and we had invested in a property together, and now we're selling it, and we're tenants in common. We're not a partnership. We're both selling it. Brendan may want to cash out or do his own exchange. I want to do my own exchange. So anyway, when the necessary assignment of the sale contract rights are given to the QI, of course, I would notify the buyer because that's what we talked about before. But the reality is all parties to the contract have to get notice. So if Brendan is also a co-seller along with me, I have to give him written notice as well of the fact of my assignment of my rights under the contract. Same thing if we were buying together.
Good. Is the exchange invalidated under the related party rules if I sell the relinquished properties, to a related party?
No, the related party rules only were set up to prevent tax abuse, which you could do by doing some tricky things by buying your related property from a related party. Those same abuses don't really apply when you sell relinquished property to a related party. So as a general rule, the related parties rules don't apply to that situation.
And kind of going back to the what we talked about a little bit, we've ordered these questions sort of, they're not quite, some of the topics move around, but like I said, it starts a little easier and then they get a little more complicated. But this next question regarding, we talked about earlier, does an exchanger only have to move forward the proceeds, or is it the sale price or greater? In connection with my exchange, my bank is willing to lend me 80% loan to value. Normally, I like to borrow as much of the purchase price as I am able. Does that work for me with my exchange?
No, it doesn't. And again, this is a common mistake a lot of people make. They're just so used to going into the bank and applying for a loan, and they don't realize that you have to roll over all your net equity from your sale into your purchase. And so oftentimes when they apply for a loan that has too much LTV, loan to value, then all of a sudden there's not enough room for the loan proceeds and to roll over your exchange proceeds. It causes a problem because if you can't get the bank to change the loan, then you're not going to use up all your proceeds in the exchange account, and it would cause them to be taxable. You should work backwards, figure out how much you need to roll over, and then apply for the loan for the difference.
Right. Next question. This kind of goes along as well with talking about the lending. Can I refinance the relinquished property prior to the exchange, or the replacement property after the exchange?
Just for the folks that are still in attendance, we only have a few more slides left to go, so we'll be done in a couple of minutes.
Yeah.
But in answer to the question, again, without getting into too much detail, like some of the other things I've shortcut, the simple answer is it's much better to refinance the replacement property after you finish the exchange. Theoretically, once you complete the exchange, refinancing your new property is no different than refinancing any property that you already own. But if you refinance before the exchange, then again, it allows for some abuse where you can kind of change the numbers in terms of how much cash you need to roll over and how much debt, and the IRS doesn't like kind of cheating in that regard. So it's much safer, better to refinance after. The only exception I would say on the relinquished property refi, if there was a sound business decision that caused it, for instance, maybe 3 months before the property was sold, the roof was damaged. It's an industrial property or commercial property, and somebody needs to borrow in order to get proceeds to fix the roof or something like that. But if you just do it in order to put cash in your pocket, not advisable.
And something that I get the question mostly on the replacement property portion of it, which you said is perfectly acceptable. But typically, how is there any time period that an exchanger has to wait before they can refinance the replacement property?
No, there's no time limit. And as Brendan knows, there's kind of a saying in our business we call the nanosecond rule that says, in theory, you can refinance 1 nanosecond after you close on the other sale. I think that's true, but I would advise that it shouldn't be prearranged or set up or applied the refi before the closing is done. It should all start after the acquisition takes place of the replacing property.
Well, and then to go a step further, what I tell people is that there can be any impediments at that point are lender kind of issues, guidelines. In other words, it might not be a nanosecond after the closing. If there's already debt on the property, they might have to wait a period of time before the lender will let them refinance. Next question. Can I, as a seller or my attorney, hold the earnest money prior to the closing of the relinquished property?
Well, taxpayers are very good, and even their advisors are good about making sure that the money from an exchange doesn't kind of touch the taxpayer or even their agent, like their attorney. But those rules only apply as of the point of time where the exchange starts. So to the extent that earnest money is held preliminary to the sale of the relinquished property, it is okay for the seller or their attorney to hold the proceeds.
Next question. Does the qualified intermediary have to be referenced on the settlement statement or sign it?
No, there's no requirement that either of those things take place, but it is kind of fashionable in certain areas of the country to show the qualified intermediaries, the seller or the buyer, on the respective closing statements and have them sign it. And there's nothing wrong with that either. It can be done, but there's no legal requirement that has to take place.
Can an exchange be done where I am the seller or buyer under articles of agreement for the deed?
So articles of agreement is the same thing as an installment sale, or sometimes people refer to it as a contract sale. And technically, yes, you can do an exchange if you're selling or buying under articles of agreement. But the challenge is typically articles are used, let's say when you're selling, when maybe you're going to finance a portion of the sale price for the buyer, and they're going to put down a chunk of change as their down payment. But you as a taxpayer have to roll over the full value of what you're selling for, even though you haven't received the proceeds that are being paid over time by your buyer. So you can do that. You can advance the money into the replacement property, but it can be a little tricky.
And along these same lines, next question, can an exchange be done where all or part of the sale price involves seller financing?
Well, it's pretty much the similar question. You can do it, but you have to make sure that you have the ability, whether you borrow funds or you have your own personal funds, to advance the portion that you haven't received yet. I'd also mention that if you're doing a contract sale for the replacement property and you need to match debt up with what the debt was on a property that you sold, the amount that's being financed under the installment agreement or the contract for sale does qualify as valid debt for matching purposes.
This is a question that I get asked pretty frequently. How are funds held by the qualified intermediary during an exchange?
Well, under the regulations, there's a lot of ways that funds can be held, but to the extent that they're held by the qualified intermediary, which is by far most common, they're generally just put in a bank account, FBO, for the benefit of the individual client, and there they sit safely. And they're separately, usually like a master account for the exchange company at the particular bank, and then there's sub accounts for each individual depositor. You can be fancy if you have a real significant account by throwing an escrow in, so the QI has to put the money in an escrow, or even a trust, but those are kind of difficult to process with the paperwork. And generally, if your QI is reputable and been around a long time and never had any problems, it's just simpler for everybody if you just send it to the QI and trust that they're going to do the right thing with the funds.
All right, well, thanks, Marty. You've been, like I said, a great resource to me as well as your clients for 30 some odd years. Wanted to, we'll move on and just kind of sum everything up. If there's any questions, we'll take those as well. Like I said earlier, my name is Brendan Lewis, and I'm with Accruit, as well as Marty is with Accruit. Not only is Accruit a leading provider of 1031 exchanges and the only company that leverages technology, we offer added value in the space of our subject matter experts. And one of the things that we're able to do when we leverage technology, I always tell people we're able to spend more time with the client, more time with the exchanger, and we've got great resources when it comes to our subject matter experts like Marty. We specialize in complex financial instruments, so you don't have to, allowing you to focus on your business. And our teams are highly credentialed with over 100 years of experience in the qualified intermediary space, 1031 exchange space. We've got 3 certified exchange specialists on staff. Marty is one of them. If there's any questions at this point, we'll take those. Otherwise, if there is not, either of us would be glad to receive any questions or concerns from anybody. Our information is there. Marty's information is listed below their phone number and email. And again, thanks, Marty, for jumping on, and thank you all for attending.